It was another excellent day for the U.S. stock market as the S&P 500 closed up by over 1%. We had some renewed enthusiasm around a possible vaccine for COVID-19, this time from Moderna Pharmaceuticals, which is now entering into phase 2 trials. We also saw a little bit of better trends in the unemployment claims, although the numbers are still high on an absolute basis. Of course, tomorrow is the first Friday of the new month, which means we have the jobs number coming out, and it is expected to be one of the worst of all time. It's just a matter of how the stock market will interpret it and whether it's willing to look past that data and look towards an economy that appears to be getting closer to reopening. Whether that's the right decision or not is anybody's guess, but that appears to be the direction we're heading. And so the stock market has been recovering nicely in recent weeks and months. In fact, the Nasdaq is now positive on a year-to-date basis, which is just incredible to think about since we were down 30% from the highs not too long ago. So tech stocks in particular have been strong, which does lead us into our trade application example that I want to talk about later on in tonight's video, where we're going to look at a technology or a Nasdaq-oriented company that was once the talk of the town several months ago and has since been somewhat forgotten, but has been trying to rebound and bottom here recently, and I want to play it to the upside if there's a chance that the market continues to be strong into the summer. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 7th, 2020. First of all, welcome aboard. If you're new, go over to YouTube, click subscribe while you're there. Check out our description area where you can also sign up for our email distribution list. We're also heavy users of Twitter. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet for us on these Market Outlook related posts. Lastly, we also have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts. And as you can see, I've got chart 6D pulled up here in front of us. And this will give us a general sense of the daily ranges of the S&P 500. I usually like to bring this up if we have an up or down move of over 1%. In months before coronavirus, we really didn't bring this up all that often. Since coronavirus, of course, that's a completely different ballgame, and you can kind of get the sense of things right here in the middle of your screen off to the right-hand side. You can see the towering bars, whether they're green or red, depends upon whether we have a big up day or a big down day. So today, S&P 500 was up 1.15%. You can see that green bar eclipsed that blue horizontal line there, which means that we moved more than 1% here today. Now again, this is a moderate move compared to what we had been experiencing just back here in March. Nonetheless, it is a good sign, at least if you're bullish on the markets, that we did have another robust recovery here today. Also worth noting is down below here, this number that you see kind of in the lower right-hand corner, that's effectively your VIX price right now, which is basically at 31. And you can see the trend of that VIX in the purple chart here has really been deteriorating ever since topping out around 84 or 85 back on March 16th. Remember, the VIX was actually already going lower by the time the stock market bottomed. Remember, the stock market didn't bottom until March 23rd here, so the VIX was kind of like a forward-looking to a degree. It had already started to decline by the time the stock market decided it wanted to bounce. And it's been in a decline ever since. So we've gone from about 84 on the VIX all the way to where we're at right now at 31, which is still considered high historically, at least in recent years. It's just a far cry from where the volatility levels were back in March. So let's now take a look here at our foregrid, our more traditional view, kind of get a sense of what happened with the other indices here today as well. So the Dow Jones was up 0.89% today, so it did underperform the S&P 500. The Russell 2000 actually outperformed the S&P 500. It was up 1.58% to lead all four of these indices. However, it is worth noting that the Russell 2000, as you can see here, does have a bearish intermediate term posture according to the market forecast technical indicator. Remember, when that background color goes from green to pink, it means that that intermediate posture goes from bullish to bearish, and the reason for that, down below you can see this green line that represents the intermediate term posture did fall out of the upper reversal zone and has been trending a bit lower the last couple of days. So we'll see if it can recover. Remember, with price still above a rising moving average, which is why that moving average line is green. In this case, it's the 30-day moving average. The path of least resistance continues to be to the upside. So there's plenty of potential here for the small caps to kind of base and bottom at these levels and start heading higher and quickly remove that bearish posture. But it is at least noteworthy that it is the only one of these four indices that does have a bearish intermediate posture right now. The others continue to be strong enough to have bullish postures and have continued bullish postures. Remember, it's somewhat difficult to keep a bullish or a bearish posture for a long period of time, yet that's effectively what we've been able to do. Let's talk about the Nasdaq now, and you can see ever since this day back here on April 6th, we've had a bullish posture on the Nasdaq and retained that full way. So we're talking about more than an entire month now where we've had a bullish posture on the Nasdaq. The Nasdaq is worth noting because you can see here something that we haven't seen for quite some time. The year-to-date label right here that I'm kind of circling with my mouse, you can see the year-to-date is now green. Notice up here we, of course, have a red year-to-date label for the S&P 500, a red one there for the Dow Jones, and a red one there for the Russell 2000. In fact, the Russell 2000 on a year-to-date basis is still considered to be in a bear market, if that's what you're going to use as your bogey there, as a 20% drop. And so right now on a year-to-date basis, the Russell 2000 is still down 23%. That's a dramatic number considering another index, the Nasdaq Composite, is positive right now. That is truly remarkable, and it goes back to what we've been sharing with you for quite some time now, which is this has been a market that has effectively been driven by mega cap tech. Whether you're talking about your FANG stocks, some of you might throw in Microsoft in that conversation as well, but your Facebooks and your Amazons and your Alphabets, even your Netflixes, there's some really impressive stocks out there from a mega cap tech perspective. And so that's allowed the Nasdaq Composite to come rallying all the way back from almost 6,600 all the way back up here to nearly 9,000 in just about a month and a half here to get us back above the break-even line on a year-to-date basis. So truly an astonishing achievement there for tech stocks. And we'll talk about a Nasdaq-oriented stock here a little bit later when we get into our trade application example as well. So this is a market that's still been willing to take on risk. And we'll see how long that lasts. There's been a lot of chatter on FinTwit here recently, financial Twitter, about how growth stocks have absolutely destroyed value stocks. And perhaps there's time for a little bit of a give back in that this is basically the most expensive that growth stocks have been versus value stocks, even including the dot-com bubble era. So some really kind of crazy things that we've been seeing in the markets here recently. In fact, I'm going to take a non-traditional segue at this point and pull up the ratio charts here just to kind of hammer that point home a little bit more. In the lower left-hand corner here, this is chart 5Q for those of you that are following along at home as premium members. This is going to be a ratio chart that tracks growth stocks versus value stocks. When you see that chart go up, like we do in this case, it means that the first set of, or style in this case, of growth stocks is outperforming the second one listed. So growth stocks easily outperforming value stocks there. And you can see that that is something that has been pretty consistent for an entire 3 months, which is the vantage point of this particular chart, or the time period of this chart. So anyway, that picture is worth 1,000 words or 1,000,000 words or whatever you want to say there. That growth stocks are the belle of the ball right now. This is where the action is at. A lot of the financial stocks have been left in the dust. In fact, we had a great conversation earlier today in my question and answer session about property and casualty insurers and what some of their obligations may or may not be with the coronavirus, and whether business interruption insurance is going to have to pay for this mess. So if you're interested in that conversation and that topic, and you're a premium member, feel free to check out the recording that is posted to our calendar here right now. So a lot of those insurance companies just really haven't been able to get their motor humming to the upside like the rest of the market. Insurance companies typically are kind of known as the prototypical value stock, right? A lot of insurance companies have PE ratios in the single digits, as an example, and that's not all that rare. We've seen that happen on a fairly regular basis in recent years. And so if you think of a typical insurance company, is it in favor in this market right now? Absolutely not. What is in favor? Well, those same stocks I mentioned a moment ago, Amazon and Netflix and Facebook and Alphabet and Microsoft, Apple. Those companies are just crushing the value stocks right now. So anyway, some of you might have noticed, depending upon how your portfolio is set up, whether you're benefiting from that or not. And, you know, we've certainly seen it in my premium classes. Some of my classes are doing well. Our top-down trend trading class had a stock that we just bought on Monday that was up 10% today alone. And that's the type of behavior we're seeing. On the other hand, you know, some of my dividend growth investing selections are still wallowing near some of their lower levels in recent weeks as a result of the market just not favoring them right now. So whether that tide turns or not is anybody's guess. But as always, we're going to do our best during these videos on a nightly basis to help you discover what is happening. And right now, this is a market that is being dominated by growth-oriented companies on the Nasdaq. Let's go ahead and take a look here at our 3 green arrows charts now, just to see where things stand there. From a general stock market perspective, not a lot to share with you because, as you can see, all 4 of our charts have a white background color telling us that we do have a mix of green and red arrows here currently. Now, the good news is all 4 of our charts remain above rising moving averages. I mentioned this on Tuesday, but I'll bring it up again, which is the 1040 crossover method. Right now is one way for us to identify that the Nasdaq is outperforming. You know, this is adding to that evidence, right? We're building the case. When you watch these videos on a nightly basis, whether you know it or not, you're picking up on things like that. And one thing that you should have been able to pick up on in recent weeks is the outperformance of the Nasdaq. Part of the reason is because of what we've been talking about here the last couple of weeks here with the crossover on the 10-week and the 40-week moving average. You can see the background color is now green. I know it's a little bit difficult there, but if I were to right-click and go to maximize that cell, you can kind of see that back behind there now a little bit better, that it's green again. And you can see here that we had this bullish crossover that occurred on the Nasdaq back in February of 2019, and we went on a pretty tremendous run there for quite some time until, of course, coronavirus hit. And then the stock market completely collapsed, and you spent about maybe 5 or 6 weeks with a bearish crossover. And now, as of this week, where we saw some hints of it last week, it didn't quite cross over last week, but we saw that it would have if it would have closed at the highs of the week. It waited until this week, and as of this moment in time, we do have a bullish crossover. Now, again, tomorrow's a big day because we do have the jobs number coming out, and it is possible maybe the stock market absolutely gets, you know, annihilated tomorrow. I don't think that's going to happen, but, you know, it's possible with a very big economic report. So as of right now, we do have a bullish crossover on the Nasdaq Composite on the 10-week versus the 40-week, but it is possible that tomorrow it goes away if the stock market responds really, really terribly. But this is working its way on a weekly candle chart, and assuming that the Nasdaq holds the level where it's trading right now, then tomorrow it will be made official. This will have been the first week of the bullish crossover. And typically you see some fairly decent trends emerge from that. You can see that like this last bullish crossover we had lasted for years, and then this bullish crossover we had lasted for over a year as well. So oftentimes we don't have a lot of give back once that occurs. Not to say that this time couldn't be different, but it is at least another positive feather in the cap for those of you that are trying to be bullish in this particular market environment. Let's go ahead and now take a look at our 12 grid analysis, starting with some asset classes here. Chart 5A for those of you that are following along at home. So as you look at this, you can see we've got a mix of green and pink charts. The green charts, of course, are bullish postures. The pink charts are bearish postures. And one thing that was a little bit different that I'm looking at right now that was not the case in the last several presentations I gave you guys is the US dollar is back to having a bullish posture. You can see the US dollar actually closed a little bit lower today, not much, but it was down 0.29%. However, we've had enough progress over the last week where the US dollar is now trading above its moving average. Now its moving average is falling, so that's why the moving average is colored yellow there. Price is above a falling moving average, so there's a conflict between those two things. But because there has been enough of a bounce in the last week, the posture itself, the intermediate line on the market forecast technical indicator, is now rising and it's back above 20 again. So while I wouldn't go on record saying this is a solid trend, at least there is a little bit of a bounce that you can work with there. Another thing that I wanted to point out is gold continues to impress. You'll know that the last time I did the presentation on Tuesday, we took that bullish trade on Newmont mining on those long calls. And by the way, we were filled on that. Sometimes it's tough to tell since I do these videos at night after the market is closed whether you're going to be filled the next day or not. But because gold actually fell yesterday, it allowed our Newmont mining trade to get filled and then benefit with the bounce there higher in gold today. So that's a promising sign. Gold was up another 1.5%. And I liked where it bounced, by the way, right? Sometimes that's just as important as the bounce itself, is where it bounced. Well, you can see yesterday after gold fell, we came down to that rising 30-day moving average, and today it responded very favorably to that, right? It tested it, didn't want to have anything to do with it, and bounced up and away from it. And that's kind of what we're hoping is going to occur, as I've got currently at least 4 bullish gold trades going on right now. One of them will expire next week with the May monthly contracts. Nonetheless, I am one that is hopeful that gold continues to see some upside potential going forward, and so far so good. We've had a nice little run out of things here. Other areas of interest. Notice that we had a big move in long-term U.S. Treasuries today. TLT was up 1.67%. Now, that's a bit of a snapback type of a rally because, as you can see here, after having some success in March when everybody was selling the stock market and moving their money into bonds, you saw this huge surge into TLT at that time. But then you had this big sell-off as the stock market started to take leadership role. People started moving out of bonds and back into stocks, and then it's really just been coasting sideways really for the last month and a half. That was up until this last week or so where we've really started to fall precipitously, and now you see the long-term bond below its moving average. That hadn't happened all that much. So these last, let's call it 3 or 4 days, have been somewhat important from that perspective. Today was a snapback rally, but even an outsized move like we saw today on TLT of 1.6% was not enough to get us back above that moving average. So I'm going to be very curious to see how things develop in the bond market here in the coming days. If the jobs report tomorrow is well received by the stock market and the stock market is off to the races, I'm going to guess that the bond market is going to sell off. We'll see if that happens or not. But at this point, this may very well be an opportunity for those of you that are looking to sell some bear call spreads on TLT to look at this to see if the moving average itself can be used as resistance now that it has broken through that moving average. A lot of it will depend, as I mentioned before, on how the market receives the job number tomorrow. If the job market if the market is not receiving the job number well tomorrow, and stocks sell off, then you might actually see money rotate back into bonds. But right now, there's been a lot of strength in the stock market. As you can see up here at with the SPY in particular, we have that strongly bullish intermediate posture. So that's that dark green background color. We have price above a rising 30-day moving average, and that's why that moving average color has transitioned from red to yellow to green, and that's usually supportive of a trend. So one thing I should point out is that EFA and EEM both went to a bearish posture. Now, these are weakly bearish postures, not strongly, so they can be reversed quite easily, but it's at least worth pointing out because that was different from what we experienced when I did this presentation on Tuesday. At that time, they both still had green background colors. Today, they have pink background colors. And so we'll keep our eye on it. Both those intermediate lines are still at high absolute levels, 72 with EEM, 74 with EFA. So both of those foreign-based stock indices are still at reasonably good levels. It's just that they've been slipping, and therefore that's why we're now starting to see some weekly bearish postures. We'll keep you posted there, but again, we have price above a rising moving average in both of those cases, so I wouldn't be entirely surprised if we can get a bounce from these levels. All right, let's go ahead and take a look now at our sector 12 grid. This will be chart 5C. As we look at this, there's a little bit more deterioration that's taken place. You can see that, of all of these charts here, we now have 6 pink sector charts and only 5 green sector charts. Remember, there's 11 sectors, so in order to make this work and have a 12 grid, the one in the upper left is not necessarily a sector, it's the entire market. So the 11 other charts that are on the board actually have more bearish postures right now than bullish postures. So we want to keep our eye on that. Remember that the U.S. stock market has largely been viewed as a fairly safe haven in this crazy world that we're living in right now, but much of it is as a result of those mega cap tech stocks that I mentioned before. So no surprise, XLK remains one of those that is strong to the upside here. You can see the intermediate line on XLK, which tracks the technology sector, is at 93. Remember, anything above 80 we would consider to be a strongly bullish intermediate posture. But we can also use those numbers to try to gauge what is the strongest sector out there, right? And if you look at the number itself, 93, remember the number can only go to 100. So 93 is approaching 100, and it is higher than all of the other sectors that you see on the board. The one that comes immediately after that is the one just to the left, and that's communications, XLC. It's at 92 and rising. And remember, communications is where you're going to find Facebook, it's where you're going to find Netflix, it's where you're going to find Google, and a lot of those big internet companies. And they seem to be very strong trending choices in the market that we find ourselves in right now, whereas some other areas are being left behind. Notice at the bottom here, staples, utilities, and real estate all struggling on a relative basis. In fact, I looked at a lot of charts here tonight before I did the presentation in preparation, and I got very, very close to putting on some short selling positions on utility stocks. Because if you look at a lot of the utility companies in the S&P 500, they all look pretty heavy right now. They're all slipping below moving averages, just like XLU itself is. I shouldn't say all of them are. There's some that are outperforming. But if you look at a handful of utility individual stocks, many of them are trading below their moving averages and have bearish background colors. So if you're looking for a bearish trade, let's say you're going into tomorrow's open, not knowing what's going to happen, just like I don't, right? It's here on a Thursday night. I have no idea how the stock market is going to receive the jobs number tomorrow morning. So if you look at the market and you see that it's acting really heavy at that time and it doesn't look like a time to be putting on a bullish trade, you might opt to put on a bearish trade instead. There's a lot of utility companies out there that look like they're kind of primed for some short selling opportunities. In fact, that was another thing we discussed in my question and answer session today. We talked about Con Ed, and one of my viewers reminded me that in this presentation, we still have a short sell on Con Ed in this market outlook video here. It's still established. It was a one canceled other order. And so it's been on for quite some time. We probably put it on over a month ago, but it's still open at this point. And you can see here that Con Ed continues to slip. In fact, it looks worse than XLU itself. Notice the dark red background color on Con Ed there. And then if you go back to XLU, it's just that light pink color. So in other words, Con Ed's intermediate posture is strongly bearish at this point, whereas the utilities in general are just weakly bearish. Nonetheless, there's a lot of really heavy charts there in the utilities, so if you're looking for bearish setups, that might be an interesting place to get it done. All right, let's get into our trade application example here for today. So as I mentioned in the intro, this is going to be a stock that was one of the most talked about stocks at the beginning of 2020 before we had any idea that the coronavirus was going to, take over the daily headlines of the newspapers. And the stock I'm about to bring up is not a stock that's going to be profitable anytime soon. So this is going to be considered a highly speculative entity. And that stock is Virgin Galactic, ticker symbol SPCE. Very memorable there, as of course this is a space-related company, one of the only space-related companies available to publicly traded investors, and this is known as a space tourism company, and of course has some ownership from Richard Branson. Some of you will remember him as being one of a serial entrepreneurs in the last couple of decades. So anyway, this is one of his more recent ventures here, and Virgin Galactic hopes to eventually bring people in space, perhaps visiting Mars at some point as a far-off goal. We'll see where it takes us. Now, when your aspirations are as large as that, you have to know you're going to be spending a lot of money, and profits are not going to come easy. In fact, just to take people into orbit, I think the ticket prices are going to be like $250,000. So without a doubt, there's a limited audience for this sort of thing. But you do have a lot of tech millionaires out in Silicon Valley as just one example. Again, remember all those companies that are seeing their share prices go up dramatically in this market move. And remember, there's a lot of employees of those companies that are getting awfully rich as well. So who knows? Maybe there'll be a market for the ultra wealthy for this. What I know as somebody who just looks at charts is that this is a company that literally took off into space, right? This is I guess that's a pun more than anything, but this company was a rocket ship heading higher earlier in the year, right? Over here on February 7th, it was an $18 stock that basically tripled in no time flat before giving up many of those gains into March when the coronavirus kind of took over the conversation. Well, you can kind of see here that Virgin Galactic has been doing a pretty good job of stabilizing. And it actually had a very nice response after it reported its earnings here a couple of days ago. Now, again, it's not true earnings, not profits, but they had an earnings report where they reported losses of 19 cents a share. The last 2 days, you can see this stock has actually responded very well. In fact, today it was up another 7% after it was up probably 10% yesterday. And as I was mentioning on one of those other charts in tonight's video, the timing and the placement of the bounce is important. And you can see here that after kind of surging above the moving average, it started kind of dwindling lower until it touched the moving average the 3 days prior to the earnings announcement itself, but it didn't really cross below it. So again, pardon the pun, but it's being used as a launch pad higher. That moving average itself had already turned up. Notice the color scheme changing from red to yellow to green. So the path of least resistance is to the upside. And when this thing kind of came back and hovered back towards that launch pad, it used it as a bouncing area right there. Now where it takes us is anybody's guess. People who have already been watching this were probably a little bit disappointed that it did not break out above the high of this candle back here today. It got very close. So the high of this candle over here on April 15th was 2107. The high today was 21 even. So it missed it by just 7 cents. And I'm sure a lot of people were waiting in the wings trying to see, okay, are we going to break out above there? And they were a little bit disappointed as the stock ended up selling back off a little bit into the close here today. Now, again, we were still up 7% today, so it was a beautiful day for the stock overall. It's just that it did not close at the highs of the session. So in knowing that, I want to be a little bit cautious here because, of course, this stock is not for the faint of heart. This is not Coca-Cola, right? This is not Procter & Gamble. This is a speculative trade here. And we're going into a day tomorrow that could absolutely hammer the stock market with the jobs number, potentially. It could also send the stock market going a lot higher. So what I'm going to do in this case is I'm going to set up a trade where I'm only going to get into Virgin Galactic if it can prove it to me, if it can prove its strength to me. If it can get above the high of this candle back here on April 15th, I'll be willing to throw a flyer into it. The good news is because this stock was trading so high previously to this recent move, that we would be able to theoretically get in and out of this as a one-for-one reward-risk relationship swing trade and not require the stock to hit a new all-time high, even though we're going to be patient and wait for the stock to go up quite a bit more. Remember, 2107 on a percentage basis is actually a pretty big number from where we're at right now, 1984. And sometimes when you do that, you give up too much of the trade, and it doesn't make sense after it's all said and done. But this one is such a speculative trade where upside potential can be very dramatic, where it could still make a little bit of sense. So I'm gonna take a speculative trade on this, but I'm only planning on getting in if it can prove it to me with additional strength from this moment in time. And if it can't, then I don't want to take the trade. So what I'm going to do is I'm going to get my calculator out here, and I'm going to show you how I can calculate the one-for-one reward-risk relationship. So over here, the high price is 2107. So I don't want to get in unless that is broken. So what I'm going to do is I'm going to put in a buy stop order at 2108. In other words, I need it to go a penny above the prior high here in April before I'm going to be willing to get into this speculative trade. So 2108, oh, hang on just a second. There we go. 2108 is that number that I'm going to set for my buy limit. Now, I also want to identify where do I want to put my stop loss if I'm wrong about this. And so I try to identify an important low that has occurred here recently as my bogey for that. And so for that conversation, I'm going to use this candle right here on May 1st. You can see there's a long lower shadow there that the low price on that candle was 1555. So that was the lowest price this stock has traded effectively in the last month. So if we were to get in as the stock breaches the high of this candle and the stock were to immediately reverse lower, we would get stopped out if it traded down below the low of this candle right here. So it would have to come down below that moving average. And that's an important conversation here because remember, this stock did a very good job of maintaining strength above that moving average last time, and we're going to cross our fingers that it'll do it again the next time it approaches it if we eventually are going to get into this particular security. So it could be our kind of our last line of defense. Now, if it breaches that moving average and comes down and crosses below that candle there, then, you know, all bets are off. We got to get out of the trade because, again, this is not a stock that's probably going to be profitable in any time soon, many years before any sort of profits will come into this particular company. So could this stock be a zero? Yeah. This is not the type of company where you just assume it's going to be around in its current entity 10 years from now. It might be a spectacular success. It might be an epic failure. So we don't want to play around with companies like that. And that's why we use their stocks as trading toys, not necessarily buy and hold mindsets. So anyway, now that we have our bogey and we can say, okay, well, we want to get out if it breaches the low of that. What I'm going to use is 2 pennies below the low of that candle there on May 1st. And so the low was 15.55. So I'm going to put our stop loss at 1553. So I'm going to take 2108 minus 1553, which means that we're taking $5.55 of trade risk to the downside, right? If we got in at 2108 and we immediately got stopped out at 1553, we just lost $5.55 per share. So if we did a standard 100 share trade, then we're going to lose $555 if that is what is to occur. So in order to maintain our one-for-one reward-risk relationship, what we need to now do is take that $5.55 per share and add it back to the price where we assume we're going to get filled, which was 21.08. So 5.55 plus 21.08 equals 26.63. So that will be our upside price target. And that takes us up to about right here on the chart. If I get the calculator out of the way, 26.63 is, I can't get my mouse exactly on it, but it's about in that range there. So if you kind of look at my crosshairs on the chart and follow that thin gray line to the left, you'll notice that matches up with that kind of two candle formation that we had at the beginning of March. These two candles over here. So that would be the area that we would be shooting for. In other words, we wouldn't need an eruption in this company all the way to these prior spectacular highs up here at 42. We just need that stock to get back to these other kind of smaller highs that we established at the beginning of March there in that $26 area. So in order to do this trade now, what I'm going to do is I'm going to right click on the Thinkorswim chart here. I'm then going to come down here to buy custom with OCO bracket. That loads up my trade down below. And again, I'm just going to leave the default 100 shares in there. Obviously, you can position size according to however big your paper money account is, whether it's larger or smaller or what have you. But I'm just going to leave it in there just for practice purposes at 100. I'm going to go ahead and clip this little paperclip icon so that way it kind of locks all those orders together as one. And then on the top line where we have this green line where it says we're going to buy 100 shares, I'm going to change this from a limit order. I'm going to click that drop down and I'm going to change that to a stop instead. So what we're doing there is we're saying we don't want to buy it if the stock goes down. We want to be stopped into our position. So in other words, if the stock goes up to a certain level, then trigger our order. And that level that I mentioned before is 21.08. Now remember, if you're really nervous about some sort of a gapping situation, another possibility would be to use a stop limit order. There you're going to complicate things a little bit further because you're going to have one level that represents your stop and then another level that represents what is the limit that you're willing to pay for it. So I am running a little bit of a risk here, and again, that's part of only doing 100 shares where it's not that big of a deal. But what I'm going to have the market do for me, or the order do for me in this case, is when it goes above 21.08, I just want 100 shares no matter what. So whatever the price is at that time, fire off a market order at that time and fill me, is what I'm basically telling the platform to do. So that comes with some risk. If the market is moving really, really fast, or if this stock has an amazing news story that happens outside of normal market hours and then the market opens and the stock gaps up tremendously, it might gap up to $23 or something along those lines. So do understand that there's going to be pros and cons with every decision you make, and that is one of the cons that I'm setting myself up to. But then again, one of my pros with that is I'm not playing games with a nickel or a dime here or there. Sometimes people, look at those trades and they miss a trade by a penny or 5 cents or something along those lines because they had that extra level of a limit order built into their trade. So again, understand where your risk is. In this case, I'm willing to take it because I'm only doing 100 shares. But what I do want to do in this case is change this from a day order to a good till cancel order, because the chances of it doing it tomorrow are probably pretty slim unless the stock market is erupting tomorrow. But anyway, we're going to leave it out there as a good till cancel order, so that way if it doesn't happen tomorrow, but it happens, let's say, early next week, we can still get the trade done. Now, moving on to the first line in pink here. This will be our upside price target after our first trade goes through. So in other words, our first trade has to get filled before the market is sent our follow-up orders here in the pink. But as soon as we get filled on our buy order and we own 100 shares in this paper money account, then these new orders will be sent to the marketplace, and they will be one cancels other orders. So either one of two things will happen. Either the stock will go up to our price target and the stop loss will get canceled, or the stock will go down to our stop and our upside price target will be canceled. But what that helps you with is making sure that you don't have any additional trades that are going through on your platform. So that's where that one cancels other is very important. So that way your platform is nice and tidy and clean, and it doesn't have some stranded orders out there that you weren't thinking about. So I'm going to also change those two in the pink there from day to good till cancel on both the upside price target and the downside stop loss. Now it gives us a chance to change the upside price target to our specific price, which I mentioned before was 26.63. And then on the downside with our stop loss, I'm going to change that to $15.53. Once all that's entered, I can then click confirm and send. And you can see what the order kind of looks like underneath the surface here. And you can see that my upside price target is $5.55 higher than where I expect to get filled at 21.08. And our downside stop loss would be $5.55 lower than where we expect to get filled at 21.08. So let's go ahead and send that off, and we'll see if we can get filled on that either tomorrow or maybe early next week, if this stock has that mojo to bounce further off of that moving average and start soaring into space like it was earlier in the year. All right, thank you for joining me here yet again. David will be back with you tomorrow as we wrap things up for the week to talk about that jobs report. Remember, tomorrow I'll be doing the sector selector as well. For those of you that want to follow that, it'll be pinned to the top of my Twitter timeline as I develop that. And I'll be curious to see if utilities continue to slip like we've seen here in recent weeks. If you got value out of our presentation here tonight, the way that you can thank us for that and encourage us to do it again for you tomorrow is to go over to Twitter and click like for us on this market outlook related tweet. Thank you so much for your attention. Best of success with your trades and your investments. Goodbye for now.